Good morning. This is your weekly update with Jim Stewart. I'm the Chief Investment Officer at Worth Asset Management for August 1st, 2022. We're going to go over the three threes for the week, our three top market movers, our three favorite and least favorite asset classes, and there has been some movement this week, and how we're positioned heading into this week on the equity side and on the bond side. So let's jump on in.
Okay, let's go over the top three market movers for the week. We have number one, July, the market bounced. Number two, interest rates. Number three, the jobs report on Friday. All right, number one is the July bounce. The S&P, if you remember, had its worst first half since 1962. That's 60 years ago with a negative 20% return, to have a very nice bounce back in July of 9.2, which is best since November 2020. Treasuries, on the other hand, had its biggest first half loss since 1788. Yes, you heard me right, 1788, 230 years ago in the first half, followed by its best return of 3% since March of 2020. All right, here's a interesting graph because this is the first half for treasuries over the last 325 years. And it goes, this was the worst period since 1788. Yes. Now, fun fact, though, is on September 2nd, 1789, because of what happened in 1788, the Department of Treasury was created. Okay, and with Alexander Hamilton serving as the first Secretary of Treasury. So pretty interesting stuff. Number two, interest rates. The Fed last Wednesday once again raised interest rates by 75 basis points. This is the second time in a row they've raised by 75 basis points. That's the first time they've ever done that. The next meeting, though, is scheduled for September 21st. And right now we're sitting at 75% chance of a 50 base rate hike and a 25 for a 75 basis point hike again. All right, now here's an interesting graph. This is on the top here in blue is the Fed funds target rate. And at the bottom is the negative GDP numbers, okay, a drawdown on GDP. We just had two negative GDP numbers and interest rate hikes. But if you go back in the last 50 years, when we've had negative GDP numbers, we were typically cutting. Every period we were cutting, but we're raising. So the bottom line is the Fed has to perfectly land this plane and this economy, and it's going to be extremely difficult as they are raising interest rates while the economy is slowing. So bottom line is I anticipate that this is going to get bumpy over the next 3 to 9 months as they try to land this plane. Number three is jobs. On Friday, the employment data comes out for July, and right now it's estimated at 250,000 jobs created. Last month, it was 372,000, so that's quite a bit lower. Okay, and Powell said last week we are not in a recession because the labor market is too strong. Well, keep in mind, jobs are a lagging indicator. So if you focus a little bit here on these orange boxes, all three of the 1970 recessions started with positive payroll growth. So we've got to continue to see positive payroll and positive jobs to make sure, yes, we were in a recession, but the last three times when inflation was as high, it didn't go that well. So we'll have to see. So Friday's jobs number are kind of important. All right, let's go over the top three asset classes for the week. T-bills, 10-year treasury, and aggregate bond are the three top asset classes. So defense is still on the field and still is the primary driver of this market, even if we have a bounce. Right now, it's considered to be a bear market bounce. And the bottom three asset classes are global equities, gold, and long bonds. Okay, let's head back to the board to go over how we're positioned.
Okay, let's go back to the board and go over our position on bonds. Now, I know I've gone over these charts quite a bit, but it gives you a good representation of we've been in protect mode for a long period. And about 2 to 3 weeks ago, we were buying bonds. In the previous videos, we notified you of that. As of that time to where they are, the bonds are up 2.3%. The 10 years gone from 1.55 at the peak down to 3.48 here. And now, as of last Friday, it is at 2.64. So far, so good on the bonds. We shall see where this goes, but right now we're nibbling and buying bonds. All right, let's go over the equities. As you can see, we've gone through protect mode, buy, protect mode. And a week or two ago, we were buying equities, and we told you that we were buying equities, nibbling at them. And since that time, the equity market is up 4.5%. Not bad. Now, I don't know where we're going. If we're going up here, going to peak and going to head right back down, don't know. But right now, we want to be nibbling because this market could take off, and we do not want to miss it. But here's the problem, though. This is a graph, a similar graph on the S&P 500, except now we're looking at the volume. Volume indicates typically that tug of war. You know, someone's going to be buying, well, I think it's going to be selling. You get a lot of volume at certain levels. And if you look over here, they're typically support and resistance levels. Well, we're right back into that support level here, or resistance level if you're coming in from the bottom side. And so what we're doing is we're probably going to stall out here for a little bit, or it's either that or it's going to reject it here, and it's going to happen here this week. And then you're either going to see it here gap up, or you're going to see it gap down. So we've got two very large resistance zones that we've got to get through before we can say all clear and that we're in a bull market. So this one is in the 41.15 to 42.35, and the next one up is 4,300 about 44.25 also. So we'll see where we go, but we've got to clear these before it's all clear. All right, here's a little food for thought to leave with you. On the CPI, as we know, it came out for June at 9.1% year over year. For the month, it was about 0.6. Well, this graph shows if we were to assume that for the next 5 months, we were to continue that rate of change at 0.6, we'd end the year at 10.2 year over year, which is higher than the current 9.1. Now, let's assume, though, that the CPI prints 0 for the next 5 months. We are still going to be at 6.3% year over year for 2022. Well, the Fed wants us at 2 to about 2.25, so we still have a very long ways to go. So we've got to anticipate that this isn't going to happen like that. This is going to be long and drawn out, probably into 2023, maybe into 2024, before we get back down to those levels. But here's our game plan to the Fed and to Congress. Fed, continue to raise interest rates. Keep fighting off this inflation. This is hurting the consumer out there. To the Congress, no more spending, no more Inflation Reduction Act. That's just a bunch of $400 billion worth of spending, which we don't need. Also, don't raise taxes. On the corporate side, on the individual side, we need to have a growth type of mode to get out of this inflationary period. So that's about it. Thank you very much for joining us. Our next update will be Monday, August 8th. Again, don't forget to subscribe, like, comment, do all those things. And we look forward to seeing you next week. Have a great week trading. Thank you.